Good morning, everyone. Welcome to today's webinar, which is titled Maximizing Your PPP Loan Forgiveness, the Home Stretch. This is the latest in a series of webinars hosted by various leaders here at Janover. All those webinars can be found on our website via the COVID-19 Resource Center. My name is Chris Zingali, and I'm a senior manager here at Janover. I'm here today with Barry Sunshine and Jill Tanzer, two of our senior partners who lead Janover's PPP task force. Today we'll be talking about something that's on almost every business owner's mind, and that's obtaining forgiveness on their PPP loans. We're going to jump right into the session here, but before that, I'd like to go over a couple of housekeeping items. Number one, this webinar will be recorded, and it's going to be posted to our website in the COVID-19 Resource Center. Number two, we will be sharing the slide deck with attendees in a follow-up email after the webinar. There's also an appendix at the back of the slide deck when you get it. We're not going to be going over those slides in person, but it's a bunch of helpful information that we thought was appropriate to share with you. And number three, I'll be monitoring the Q&A throughout the session, so feel free to submit questions at any time. You could, if you hover over the screen here, it should pop up with a little Q&A box. You could click that and ask questions. I'm going to try to answer most of these questions in real time, but for those questions that I don't get to, that means we're either going to be saving them to the end to discuss as a group, or you can feel free to just share that, to reach out directly to myself, Joe, or Barry via email after the session. Let's just get into it. Joe, I think you're leading off.
Yes, thank you, Chris. Good morning, everyone, and thank you for giving up some of your time to attend our webinar today. As you know, the Paycheck Protection Program, we call the PPP, is a lending program run by the Small Business Administration. It was authorized by Congress in late March as a response to the crisis faced by businesses in light of the coronavirus. The main attraction, if you will, is the ability to have the loans forgiven. What that does is make them into government grants. So we at Janover have always looked at the program as having three stages. Stage one was the application process to get that money. Stage two was monitoring the expenditures and controlling payroll during the covered period. Stage three is the application process to get forgiveness for the maximum benefit. This webinar is focused on the forgiveness stage, where many businesses now find themselves after months of anticipation. So let's talk a little bit about what's going on in the news nowadays. One of the things that you probably have been hearing about is the effort to try to get back some more funds. What can Congress do for us? And right now we're sort of in a little bit of a waiting game. The House of Representatives initially wanted a $3 trillion additional package, whereas the Senate only wanted a trillion rather, of additional package. Right. So there's a compromise right now in the House of Representatives to go to 2.2 trillion, but they haven't voted yet. There's still negotiation going on. We're not sure what we're going to get, but there is in this package, just so everyone knows, there's more money for small businesses, and the target really is to get to the smaller businesses of those groups. There's an additional extension of the $600 for the unemployment insurance from the federal government. There's money for education and for state and local aid. So we're not sure where that's going to go. People are saying that the Senate may not go along with this, but there is at least some talk about it now after a long delay of not having anything. So what's in the news also? There's been lots of fraud. Apparently, there's been a fraud regarding how money is being spent. People have been buying yachts and limousines and Lamborghinis, all kinds of things. And so this is a target, obviously, when the SBA does audits, something to be cognizant of. We're hearing that a lot of this is going on in Florida, but I think it's probably not limited only to Florida. There's also talk about whether or not the $150,000 loans will be forgiven with less requirement through the application process to make it a little bit easier to get the money. Again, this is something that has not been passed, but it was exciting for people who have the smaller loans. We just don't know where it's going there. It's also important to note that some people have already submitted applications for forgiveness. And right now, just this week, Treasury announced that they're going to start reviewing these applications. So we'll see where that goes. So to go back to the agenda, we just want to make sure that we talk about certain things today. One of the things are going to be the key concepts, the strategies. So one of the strategies, of course, is choosing whether you go with 8 weeks versus 24 weeks. We're going to get into that a little bit later. Safe harbor issues. We also want to know everything about this process. Barry's going to spend a lot of time about that process. We want to know what effect this is going to have on financial statements, because initially it comes in as a loan, but what happens if you get forgiveness? We'll talk about that as well. We'll talk about the tax effects that forgiveness brings, because there is some quirkiness in this whole plan. The IRS made an announcement that made everybody uneasy. What effect does that have on your tax planning and estimated taxes? We'll get into that as well. And of course, we want to talk about the audit process and what kind of records you need to retain and for how long. So that's kind of what we want to go over today. So let's get into some of these key general concepts. Okay, so as we know, the loans are eligible for either partial or full forgiveness if you spend the money in the right way. And spending the money in the right way obviously involves making sure that you stay in line with what the program originally said. But if you had a loan, if you received money, let's say before June 5th, you actually have an option to choose between 8 weeks and 24 weeks. If you received a loan after June 5th, then you only can go with 24 weeks as your covered period. And we'll also talk about why there are some benefits in that, going 8 versus 24. As we mentioned, we have strategies that we've been talking about, but just understand that the covered period started on the date that you received the money. There was a lot of confusion about that in the beginning, but that's clear. Payroll costs must be 60% of the money that's spent. We believe that maybe you want to make sure that you get more than 60% in, maybe even 100%, and there are some reasons for that. But payroll costs must be at least 60%, otherwise you're going to lose some forgiveness. The forgiveness application must be submitted no later than 10 months after the end of the covered period. Again, the covered period begins on the day you receive the money. It's either 8 weeks after or 24 weeks after that you have the end of the covered period, and there's definitely incentive to get this application in within the 10 months that follow that period, because failure to do so means that payments must begin immediately, as opposed to having a deferral period and paying that money back. So that deferral period is itemized below. The unforgiven portion of the loan has an interest rate of 1%. That loan term has either 2 years to start paying back or 5 years. So it's 2 years for those that took their loans before June 5th, 5 years for those who took the loan after June 5th. But even for those who began before June 5th, they may be able to negotiate with the lender to extend that loan to 5 years. And it's important to note also what those loan terms are. So the way the law was written, the loans were supposed to be non-recourse, which means that you weren't personally obligated for the return of those monies in case there was any part that was not forgiven. But we know that some people have been getting applications where they were made to be guarantors, which basically makes that a recourse loan. And so unfortunately, it's already signed, and therefore it is what it is at this point. But it is important for you to take a look at your application, make sure you know where you stand with this process. So we'll just leave that to you to decide, what action, if any, needs to be taken on that. So let's get into a little bit about what costs are eligible for the forgiveness. Okay, clearly payroll costs. So that includes your gross payroll. It includes certain benefits, including pension benefits and health insurance benefits. And it also includes state and local payroll taxes. Those state and local payroll taxes we sometimes call SUI for state unemployment insurance. New York, if you have payroll in New York, you might have the MCT-MT tax, and you might have the ECET special tax as well. And those all fit into that state and local payroll tax. Eligible costs also include the interest on mortgage obligations, but only if the mortgage was incurred prior to February 15th of this year. Same thing is true for rent payments. When we say rent, we're talking about rent on real property, sometimes on personal property as well. And that's only in effect if the lease agreements were enforced by February 15th as well. And utility payments, we're talking about electricity, we're talking about heat, we're even talking about internet service. As long as the services were enforced before February 15th, that's the key date. Obviously, that's kind of when the United States started to recognize that we were having trouble with the COVID. And so that's where that February 15th date comes from. The cost must be paid or incurred. And there was a lot of discussion about what that meant initially. But what it really means is that anything you pay during the COVID period is going to count, as long as it's legitimate as an eligible cost. But the incurred part means that even beyond that, even if you pay something following the COVID period that was incurred during the COVID period, it counts as long as it is paid before the next billing date. So as an example, if you had a utility bill that covered part of your covered period, but extended into the period that followed the covered period, the piece that was within the covered period, that piece can be counted as long as it's paid before the date that utility bill is billed for. So that's the whole key on that one. And that brings in a lot of additional possible covered expenses and makes it even easier. There's an alternative payroll covered period where you're allowed to instead for payroll only, we're only talking about payroll here, but for the payroll only, instead of counting from the beginning of the covered period, you can count from the start date of the first biweekly or weekly payroll that you have. This does not apply to monthlies. It does not apply to semi-monthlies or any other payroll period except the biweeklies and the weeklies. And so this alternative covered period may work better for you. You have to take a look and see whether it's better to start with the covered period or this alternative covered period. But again, that doesn't apply to the other things like rent and mortgage interest and utilities. This is only for payroll. One of the key concepts is a full-time equivalent. This is for employees who, as individuals or in combination with other employees, work at least 40 hours per week. So an FTE equivalent would be someone who works at least 40 hours a week, or somebody along with others gets there. And so each person is looked at individually. One person may be a full-time equivalent. Another person may be less than a full-time equivalent. And there's a whole bunch of computations that we're going to get into with that. Barry's going to go into great detail on the application process. Some of the recent developments that we've seen. Next slide, please.
Thanks, Joe.
Okay, this is just a brief little discussion about the owners. Everybody's been asking, can we do this, treat the owners the same way we treat our other employees? Well, the government says no, there are limitations. We have a chart here based upon whether you are in a C corporation, S corporation, a self-employed person, or general partners, there are differences. And obviously for corporations, there's an ownership issue. More than 5% or equal to or more than 5%, you're limited in this way to the amount that you've taken in compensation, or these fractions that you're seeing on here. And whether health insurance counts or whether you can count state and local taxes, again, depends upon which classification you are. This is a chart. You'll have it as a reference. It's really very easy to follow. But of course, we're available for questions if there are any. So we're going to cover this also in greater detail later on. A couple of things came out recently also. Mortgage interest paid to a related party is not eligible. So as an example, if your spouse gave you a mortgage on your business property, obviously paying interest to that spouse would not count in this program. Rental clarification, there were a lot of questions about this. We know that if you are a tenant, you can count the rent. However, if you are leasing to a subtenant, you need to subtract out that subtenant's portion. That's an obvious answer to this, but that's something about it. If you have a home-based business, you can count the pieces that are related to your the business itself as rent, but you can't count any household expenses that are eligible. So you need to do an apportionment as you would just for your income taxes. And related party rents, that was an issue that faces a lot of people. A lot of people have properties that they rent to their business. And so what about rents that are paid to the owners themselves? The government has said on that you're allowed to take rents, but only limited to the mortgage interest that is attributed to that portion of the space. So if you have, let's say, you have a home and you rent out 50% to yourself and 50% to somebody else, the piece that you are paying for yourself in rent is limited to 50% of the mortgage interest. Okay, obviously the other tenant will deal with that rent and pay, declare the rent themselves for the SBA if they qualify. But for your piece of it, you would only be entitled to 50% of the amount limited to the mortgage interest. And again, they also specified that the lease itself and the mortgage must have been in effect by February 15th of this year. At this time, we're going to get into the forgiveness application. I'd like to introduce my partner, Barry Sunshine, who I've worked with for years. Very knowledgeable guy and just brilliant in taxes. It's my pleasure to bring in Barry Sunshine.
Thank you, Joe. I appreciate it. And thank you for that excellent overview. Just a couple of things, just in case my voice sounds a little cracky, it's because, yes, I stayed up late watching the Yankee game and the game was over at like 1:30, 2 o'clock in the morning. So if there's any scratchiness in my voice, I apologize. But so I saw that there was one question that came up in the Q&A. Should we submit the application now or wait? Joe and I and people in our office talk about a strategy, and I'm talking with clients about a strategy about the timing of submitting applications. Generally, I'm telling my clients to hold off and be patient in it because there's a lot of unanswered questions. And if you submit your application now, assuming the bank is even accepting the application, because I know some banks have a portal and they haven't opened up the portal for applications, but I'm saying I don't want my clients to be the test case. I don't want them to where the SBA and other folks are looking at things unless there's absolutely no risk, or it's for a slam dunk on forgiveness. So I'm telling people to exercise caution and be patient about it because you have 10 months after the end of the covered period, as Joe mentioned. So unless there's specific reasons, and there may be specific reasons that you want to file early for forgiveness, if there's some specific reasons that you want to do that, we'll go over that a little later on in maybe some Q&A session as to doing it. But let's just talk about conceptually. The first thing is if you want to look at conceptually how this works, what you do is, as Joe enumerated, the eligible payroll costs and non-payroll costs. You accumulate all of those eligible payroll costs and non-payroll costs during the covered period. And again, the covered period, as Joe mentioned, could be 8 weeks or 24 weeks. You choose it. The taxpayer can choose whichever is more beneficial to themselves. And the first thing you do is you subtract out the wage reduction. We'll go into that a little bit more detail, but if you gave employees a greater than a 25% haircut on their salaries, you have to make a reduction on that, and that's a dollar for dollar reduction in this. The next thing is then you come down to eligible cost, adjusted eligible cost. And there you multiply it by the full-time equivalent reduction quotient. Now, that's a percentage of it. So the FTE reduction, I think, is a lot more important than the wage reduction, because a wage reduction is a dollar for dollar reduction, whereas the FTE reduction quotient or ratio is a percentage decrease. And then once you get to that number, applying the FTE reduction factor to the eligible wage cost, then you come down to that's the amount of the amount that could be forgiven, and you subtract out any EIDL grants that a borrower or business received, and that would be the PPP forgiveness. Of course, it gets capped at the loan amount. Thank you. Next slide. Then this is a sample in the calculation of it. There's the SBA came out with two forms, a 3508 form, which is, I'll call it the long form. And then they came out with an easy form, a 3508EZ. And if you can make certain representation and you can get full forgiveness on your loan balance, you may want to choose the 3508EZ form. If you don't meet all the criteria and you make the bad representations, that's not good. The SBA or the bank may ask you to resubmit your application, and that's just going to come to delays. So you want to make sure that you file the right application. But if you just follow this application just quickly, you'll see that the payroll costs on line 1, then there you add in the mortgage interest, and then you add in the business rents or lease payments, as Joe talked about, the business utility payments. You just list them there. Then you have your adjustment for the wage reduction. Then you subtract it, and then you multiply it by the FTE reduction quotient or the FTE factor. And that's the what they refer to is the potential forgiveness amount. You compare it to your PPP loan, and you got to make sure that the amount of the total forgiveness costs, at least 60% is payroll. Otherwise, you have additional forgiveness. And then once you get to that number, you take the smallest of the loan amount, the potential forgiveness, and the payroll cost numbers. And that's the actual amount of the forgiveness. And that's in the actual application. There is an interesting thing, and Joe's going to go over it in a little bit later on in further detail, about this calculation. When they extended it from 8 weeks to 24 weeks, you could actually spend more money than your PPP amount. So your payroll goes, because of 24 weeks, it could exceed a lot more of the PPP loan amount. So you'll see an interesting thing, and quite frankly, I thought it was a little surprising that you can actually get easier forgiveness because of the 24-week period. So we'll go over that in a little bit more detail. Next slide. When you look at the actual detailed, now we're getting a little bit more granular. So when you look into the actual payroll costs, these are what we consider eligible payroll costs. Their gross salary, wages, bonuses, commissions, and similar compensation. It includes tips, cash tips and equivalents. It includes vacation pay, and even if you dismiss somebody, separation fees and so forth. There is a cap on it, because the maximum compensation on an annualized basis is $100,000. So if you look at the table on the right, for non-owner employees, if you have a covered period of 8 weeks, the maximum amount for any employee is $15,385 that you paid during the covered period, and that would be eligible for forgiveness. And if you have a 24-week period, any non-owner non-owner employee would be eligible for 46,154. So that's those numbers. Now, compensation does not include anybody who's making or any payments in excess of $100,000. So if you paid somebody, if you had an employee non-owner who was making, let's say, $600,000 a year, even though in the covered period you paid them more than that 46,154 in a 24-week period, it's capped at the 46,154 number. If you paid any employees residing outside or residing outside the United States, that is not an eligible cost because they want to keep these compensation for forgiveness PPP monies within the United States. And there's an adjustment for qualified sick leave and family leave wages. And to the extent that they got a credit, they're not allowing you a credit and also forgiveness under this Family's First Coronavirus Response Thing. Next slide, thank you. We talked about this wage reduction, okay? And when you have the wage reduction, it's what you do is you take, you have to look at all your employees that you paid in 2019. And if any employee's annualized salary was more than $100,000, they're excluded from the compensation. So we're talking about any employees that got paid in 2019 more than $100,000, and you have to compare it to the first quarter of 2020. If those employees in 2020, the first quarter of 2020, compared to the covered period, if any of those employees got reduced by more than 25% in annualized or hourly compensation rate, then the payroll wage reduction kicks in. So for example, if somebody was getting paid $1,000 a week, and let's say in 2019, and then in the first quarter of 2020, they were still getting the $1,000 a week. If you paid them $800 a week during the covered period, you didn't reduce their compensation by more than 25%, so you don't have a wage reduction. However, if you reduce that same employee from $1,000 a week to, let's say, $650 a week during the covered period, then you would actually have a dollar for dollar wage reduction for the amount of that exceeded the 25%. We went over those in previous webinars, and we have some information on actually how to do those calculations in past performance and later on in these webinar appendix. Next slide. If you did have any wage reduction, there is a safe harbor. So if you did experience where you reduce someone's salaries by more than 25%, there's safe harbors that allow you not to have this adjustment made. And the first safe harbor is if both of the following conditions are met. One, if the annualized average annual salary or hourly rate between February 15, 2020 and April 26, 2020 is less than the average annual pay or hourly rate as of February 15, 2020, and the average annual pay as of the date of the forgiveness application or December 31st is greater than the average annual pay as of February 15. So if you restore these employees back to the previous wages, then you don't have any wage reduction piece. So that's something that what we're doing right now is I'm not seeing this from many of my clients in looking at these applications, but if you're an employer and you're seeing that you did reduce somebody's salaries by more than 25% or their wage rate, then you may want to look at restoring it if you have extra PPP money that you want forgiveness on, so you can take advantage of this rule. Okay. That's the wage reduction. We're not going to spend a lot of time on this because I'm not seeing this really kicking in from a lot of our clients. The next one is the FTE one, I think is the FTE. Now it's interesting. Let's compute the FTEs, full-time equivalents, and this is a percentage decrease, okay? There's two different methods of calculating your full-time equivalent employees, and there's a lot of questions in here, and there's a lot of unanswered questions on it. But let's just go through what the SBA's guidance and the Treasury Department's guidance are there. There's two ways of determining FTEs, whether your employee is a full-time equivalent at one or anything less. Now, the first thing is the standardized method. So what you do is you take during the covered period all of the hours worked for an employee, and you divide it by the number of covered week payroll, and you also divide it by 40. If they're at least, and it's capped at 40 hours a week. If somebody is working 40 hours a week for the whole covered period, then that employee is considered a 1-0 full-time equivalent. If somebody was working 20 hours during that week, then it would be a half, 0.5, a full-time equivalent. And then what you end up doing, and that's the standard method. And if somebody worked 10 hours, or let's say 6 hours or 5 hours, you would divide that 5 hours divided by 40, and you can actually get 0.1, 0.2, 0.3 of a full-time equivalent. And what you have to do is you have to do this calculation on the base period as well as during the covered period. And then you eventually you're going to have to measure how much your full-time equivalents are during the covered period as a ratio to the base period. And we'll go into the reference period or the base period down below. If you don't want to start dealing with fractions of 0.1, 2, 3, 4, 5, the SBA offers a simplified method. The simplified method is if anybody's working more than 40 hours a week, you could just use one full-time equivalent. And for employees working an average of less than 40 hours, you could just use 0.5. It seems like that's sometimes better or easier. But what happens is if you use for the base period and in the covered period, the standard method, you have to use it for both, or if you use a simplified method for the base period or the covered period, you have to use a simplified method. The reference period, just what we talked about before, I call it the base period or denominator. It's basically what you have to do is you have to look at how many average full-time equivalents that you had in either the February 15th, 2019 to June 30th, 2019 date, or the January 1st, 2020 to February 29th, 2020 date. And if you're a seasonal period, you can use a flexible 12-week period. So that's how you calculate the full-time equivalents calculations. It gets into far more details, but at least you have to look at this in the strategy on this. Next slide. One of the things that we're looking at right now, and this is very critical, is a lot of businesses aren't able to operate at full capacity. And they are experiencing some full-time equivalent reductions during the covered period as it relates to the base period. So there are exceptions to it. So the first thing is if a borrower or a business made a good faith written offer to rehire an employee during a covered period, and the employee said, you know what, I really don't want to come back to work, I feel uncomfortable, and they actually reject the offer to come back from work, and the business reports that person that you offered to come back to work to the state unemployment within 30 days of rejection, then that person who didn't come back to work will not actually affect your wage reduction. And that's one of the provisions you can make an adjustment for. Also, if you had any employees that you fired for cause, voluntarily resigned, or went from full-time to part-time, or if you were using I'll call it the standardized method, if they asked for a reduction in hours because they had to take care of people at home for whatever reasons, you're not going to have experience of full-time reduction portion with respect to that. So those are some of the careful things that you have to do. I'm telling my clients to be very, very cautious on on these things. If you're taking advantage of any of these provisions, I'm asking my clients to get email documentations from the employee so you can document this and so forth. There also the PPP Flexible Act, the new provision that came in when they kicked in the 24 weeks. They also added some other items in there. Some of the other items is one, if you are unable to hire an employee who is an employee before February 15th, maybe they don't live in the area anymore, or if you can demonstrate an inability to hire a similar qualified employee on or before December 31st, 2020. So if you were doing specialized work and you needed a physicist to do some work, or you needed somebody with a special skill, and that person didn't come back and you can't find the replacement for that person, then you're not going to be adjusted for that. Next slide, thank you. There are other safe harbors for the full-time equivalent reduction. One of which is, this is very, very important and it's very careful. You got to be careful on this one, but it's very, very big. If you're unable to return to the same level of business activity as you operated before February 15, 2020, due to governmental requirements or guidance issued, and it's relating to the COVID-19 safety standards, you're not going to be affected by that. There's a few clients that we have that may be operating restaurants, cruise ships, or they may be operating gyms, or they may be operating construction companies. And some of these construction companies may have had some of these projects deemed to be non-essential projects, and they were closed, or they couldn't operate at the same number of capacity. If you were able to document that, you were able to, then you're not going to be able to have a haircut for this FTE reduction. Now, what's interesting about this piece is it says governmental requirements or guidance, okay? It's not generally New York City's requirements or the state's requirements. It's specific to guidance issued by the Secretary of the Health and Human Resources, Director of Center for Disease Control and Prevention, and the Occupation Safety and Health Administration. So these are governmental agencies. And what I'm telling the clients and various clients to do is, if you have these situations and you go into these websites and you can get this documentation, you should save the site off the website, because the government are changing the standards with great frequency. And if you have to prove why you made an adjustment on it, you may want to make sure you have the proper documentation. There's another key safe harbor, number 2, which was called the safe harbor. And what one of these things is this: if the borrower reduced your full-time equivalent employees from the period of February 15th through April 26, 2020. So if you had your full-time equivalents reduced during that period, which most companies would experience that, and if you bring your full-time equivalent levels back to the original level by no later than December 31st, then you'll have that safe harbor, and you won't have that FTE reduction piece. And that's interesting because, okay, so if you had 200 employees on February 15th, on April 16th, let's say you closed your business, you only had 10 employees. And let's say during the covered period, you just had very few people coming back. Your business was not at full capacity. But by December 31st, if you bring your level back up to that same number that you originally had in February 15th, even though during the covered period you incurred a wage reduction piece, as long as you restored it, then you won't have to have a cover. Okay, next slide, thank you.
Thanks, Barry.
Some of the non-cash compensation, Joe covered a little bit of it, which is the health insurance, and it'll also include the retirement plan and state employment insurance. So we can just continue with that. Those are some of the costs, and they just have to be incurred during the covered period as Joe talked about before. Next slide, thank you. We talked about this a little bit. Joe talked about this a little before, which is it's capped at $15,385 during the 8-week period for owners, and for the 24-week period, it's $20,833 for owners. And how it gets mechanically calculated, that $20,833, whether compensation or health insurance is included and retirement pay is on top of that. Here's a little chart that says whether it should be added on above it or should be included in those caps. Okay. We talked about this before. Joe went into good detail on this about mortgage interest payments, rents, utilities, and eligible costs must be paid during the covered period or in the next billing cycle for non-payroll piece. And those are some of the things. They did come up with some guidance as to whether or not if your lease agreement was up, let's say on, let's say March 15th, and then you renewed your lease consistently, then even though it wasn't the new lease wasn't in force on February 15th, if it was just an extension or renewal of it, that would be included as well. Next slide, thank you. So we had some surprises in this, and here I'm going to turn over it to Joe because there was some interesting surprises in here. So Joe, why don't you come over with some of this thing and talk about some surprises that we experienced in this.
Thank you, Barry. That was terrific, what you covered there. So I want to cover in the next little segment here some of the key unanswered questions and also the effects on the financial statements. So this first point, which Barry was leading into, this is one that has puzzled us a little bit because the application process, the application form itself actually makes it seem a lot easier to qualify than we thought. And that's because, as Barry mentioned early on in his presentation, you can spend more than the loaned amount for eligible costs. I mean, you can effectively use your own other money to pay for payroll, pay for rent, and pay for utilities and mortgage interest, and possibly then, but just by virtue of the fact that now we're dealing with 24 weeks, it makes it a lot easier to qualify. Back when it was an 8-week covered period that we only, before they changed it to allow for 24, it was challenging because your original loan was based on 2.5 months of payroll and payroll costs. And so to spend all the money and get qualified, particularly if you had what we call the FTE reduction, it was kind of difficult to get full forgiveness. But if you stay with this application the way it's written today, it looks like you can now spend over 24 weeks plenty and allow yourself to get full forgiveness, even if you have an FTE reduction. So as you can see on the example, if you spend over here, it's over $1 million, $1,025,000 in covered costs. With an FTE reduction of 75%, meaning that you've cut back on your workforce about 25%, you see that the modified total, which is line 8, is $768,750. But the loan amount was only $500,000, which means that you still qualify for the $500,000 forgiveness because it's the least of the 3 items that you see there. And that seems to me, and we've talked about this and we've gone back and forth, it seems to me that this was not the original intent of Congress. The original intent of Congress seemed to have been expressed in the law where they said that if you cut back on your workforce, you're going to get penalized in the form of a reduction. So there is always a possibility that there will be a change in regulation that comes from SBA. We haven't heard it so far. So we're still relying on what we're showing here as the current column. But in case the SBA does come back and say, you know what, this was not the intent. It was never really supposed to be this way. We just goofed on the forgiveness application, well, then look what happens when you go to the potential. So if you have an FTE reduction of 75%, but you're only working with the $500,000 that you were loaned instead of what you spent, including other money, now you see that your line 8 is 375,000, and all of a sudden in this example, you now have a loan to be paid back of 125,000. So I want to emphasize that's not what the application says today. It's only a potential. We feel it's important to tell people. Some people who I've mentioned this to over the last several weeks have said they're going to put money aside just in case. That's up to you. You don't have to do it. Again, you may be able to follow this application the way it is. But as Barry mentioned before, there may be some incentives to waiting on your application, not to rush it through. This may be another reason not to rush it through. Maybe you want to wait. And why wait? What's the advantage of waiting? Well, maybe instead of looking at the 24-week period where you might have had a reduction in your employees, maybe in the 8-week period, even though you didn't spend all the money, maybe you didn't have a reduction in your payroll. And maybe there you have an FTE quotient of 100%. And maybe that's better. It may be better to lose, just the money you didn't spend as opposed to suffering a bigger one when having a bigger reduction quotient. So this is part of the strategies that we need to look at. May I go to the next slide, please? So some of the unanswered questions, Barry went over in good detail about the FTE, how it's calculated. And we are doing exactly what Barry had said, which is for each employee, we're taking the hours that they work each week. We're taking the hours that they work, over the covered period. We're then dividing that by the number of weeks in the covered period, and then dividing that by 40. And then we come up with a number which is either over 40 on average or less than 40 on average hours a week. And at that point, it's either a 1 or less than 1. And if it's less than 1, you have the simplified method or the regular method to use, just as Barry mentioned. But there are some people who feel differently. Maybe some people say, well, you should take each week and divide that through and come up with fractions for each week and then add them all together and average them out. Well, we don't believe that's accurate, but it's not spelled out specifically in the application instructions. But we believe that the proper method, which is consistent with what we're doing for wage reduction, is to do it on the overall period. One of the key unanswered questions, this is a big one, this was in the news a lot, this issue about economic uncertainty. When you filed your application form originally to get money, one of the statements that you confirmed was that there was, because of current economic uncertainty, you needed this money. These funds were necessary to have your business continue because of this current economic uncertainty that was out there. And, most of us, I would say, probably had many reasons to doubt economic uncertainty. First of all, would we be changing our payroll? Would we be necessary to scale down our workforce because of the COVID? Would we need to go out and get a loan? That was another question. Maybe we need to go out and actually borrow from our bank because we don't know how we're going to make it through this COVID. We were all saying these kind of things back in March and April. Another thing is, how about our customers and our clients? Will they survive? How will they be able to deal with this hardship? Creating economic uncertainty. Would we be classified as an essential service or a non-essential service? Again, the distinction was that essential services were allowed to go into their offices and conduct business as usual, and non-essential services were not allowed to go into their office or their work sites. So there were lots of reasons for current economic uncertainty at the time when we made out that application, okay? But it hasn't been itemized in any way. It's not in the application. They don't give you examples. You just have to be able to demonstrate that in some way. So we've recommended to our clients to document as much as possible, emails, letters that you may have written. Maybe you applied with loans and maybe there's some forms you filed, figured out for that. Maybe you got something from one of your customers saying, well, we're having a hard time paying you because we're not able to work, things like that. Those are the ways that you might be able to document that. Okay, so I'd like to go on to the next one. Another thing that's been out in the news, I'm sure all of you have heard this one, that loans under $150,000, you might be able to get forgiven without going through this whole application process, making it simpler to do it. That was talked about in Congress. At this point, that's not been passed into law. So right now, you're still facing the application process. One of the things Barry mentioned, that there's an easy form, maybe that would be better for you. You'd have to take a look at it and see which is best for you. Obviously, another question is, and here we are facing an election in the next few weeks. What would happen if there's a change in the administration? Would there be an effect on the PPP? It could very well be, because obviously Democrats and Republicans feel very different about how these things should be done. So we've talked already about changes in how the plans got moved from 3 trillion and 1 trillion to 2.2 trillion, and maybe it'll change again by the time it gets negotiated. So obviously there are differences. There were differences even in terms of how much of this would be tax deductible when you spend money on these expenses. So there's a lot of questions around that one, and obviously we don't have the answers for that. But let's talk a little bit about the financial statements, because even the financial statements bring questions. So
and Joe, just to jump in here, I know there's still a lot of really good stuff to get through. Figure we have another 10 to 15 minutes time.
Thank you, Chris. Yeah, I'll try to go through this quickly. The AICPA came out with some answers for some people. People are coming up to financial statements either for year end or on the interim basis, and they want to know how to treat this PPP. Some of those financial statements go to their lenders, and they need to make sure that they're done correctly, and not just internal. But so the AICPA came out with 3 different possibilities. One obviously is to just hang it up as debt to make sure that you get forgiven first, which means you don't pick it up as income until after you've been forgiven. Second one says you can pick it up if you believe that you're going to get assurance, then you can pick it up as you spend the money. So if you really believe that you're going to get that forgiveness, you can then pick it up based upon the spending of money ratably over how that money is spent. And the last part is recognize it as an income, but just treat it sort of as a contingent issue and sort of hold it in abeyance. And then that sort of is similar to the first one, but it's a different placement on the financial statement. But you got to think about what's going to happen when you send in your financial statements. There are covenants that you may have given. And maybe if you show loans on your financial statement, you may not pass your covenants for working capital and debt to equity. So this is something that you may have to consider in greater detail. So reach out to your financial advisor on this one. Barry, let's go back to you and let's find out more about the tax effects.
Yeah, okay, so thank you, Joe. That was great. The other thing is in the CARES Act, it specifically mentioned that any of the loan proceeds that is forgiven is not considered taxable income. It's excluded from your gross income. So it's treated very similar to municipal tax exempt interest income. So it's not subject to income taxes, okay? And that's for the federal. Now, so a lot of people went on the presumption that there was no taxable income associated with it. But then subsequent to that, the IRS came out with Notice 2020 that concluded that any expenses attributable to any PPP loan that is forgiven, those deductions will not be deductible. In other words, if you had, let's say, a $200,000 PPP loan, and let's say you had $200,000 of payroll costs that it paid, and let's say that whole $200,000 of PPP loan is forgiven, and you don't have to pay it back. You have no income associated with the PPP loan forgiveness. This notice is basically saying that $200,000 of payroll costs are non-deductible. So it defeats the purpose of what Congress's intent was. I don't think that that's correct, the IRS's conclusion, but, and I spoke with my senator about its conclusion, and he agrees, and there's potential, and they introduced legislation to change that IRS ruling, but to date, there isn't anything. Because these deductions are based on how much is being forgiven. If you go to the bank and the bank all of a sudden concludes that 100% of that loan was forgiven, and then later on the SBA reviews your application, we'll get into the details of that, and they conclude that, let's say, that $200,000 loan was fully forgiven, the bank concluded. If the SBA later determines that none of that loan should be forgiven and you have to pay it back, that may be outside the 3-year statute of limitations for filing a refund claim. So there's considerations to filing protective claims. It's going to get messy. So there's going to be more guidance down the road from the government. Now, in New York State and other states, they decoupled from the CARES Act, which means that forgiveness for federal purposes, that's not taxable, is taxable for New York State. So we got to wait for more guidance on it, but it looks like then those deductions would be deductible for state purposes. But again, New York State and other states that decoupled from it will have to come with some conclusions. But what's interesting is an issue because a lot of our clients operate as partnerships or LLCs. What happens is if you had $200,000 of eligible payroll costs, which includes, let's say, partner or member draw, what happens is payroll costs to non-owners would be deductible, and payments to partners would be eligible too, but they're not deductible. So it raises an interesting question that if you had $200,000 of PPP money that paid $200,000 of partner compensation, more than one obviously, and you had employee compensation of $100,000, it looks like $100,000 of the employee compensation would not be deductible, but there's no loss deduction for the members' salaries because it's not deductible. It raises a couple other points, and I'll just go quickly. Even if you had PPP and you plan on getting forgiveness, you still can defer your FICA tax until December 31st. But if you're planning on if you got the PPP money, you can't apply for the employee retention credit. So if you don't have any PPP money, you can get the employee retention credit, and I suggest looking into it. This raises a lot of different year-end planning ideas. You really got to take a look at it. You got to start now. But there's a lot of unanswered questions that will be raised. So it's a lot of different calculations that you need to do. So that's the point of that. The next thing is the actual application. So once a borrower or a taxpayer decides to submit the 3508 to the bank, some banks' portals are not open. Some banks are taking on the applications. So once your bank is eligible to take it on, it's the same bank. You're going to be applying for the same bank where you got the money from. You have, again, as Joe mentioned, 10 months after the covered period is complete to submit it. And if you do it after that, you may have to be starting to make payments. So once you submit the application to the bank has 60 days from receiving the completed application to review your application and decide on whether there's partial, full forgiveness, and how to determine that. The bank must make that determination based on all the information that's supplied to the bank. Within 60 days, they have to report to the SBA. Okay. So, and then the way they do it is they say to the bank, that they say to the SBA, 60 days, this company applied for $200,000 loan, $200,000 we think is full forgiven. So what they do is the bank requests from the SBA full payment of what they think should be forgiven. Okay. And then the SBA has 90 days to review those applications and remit the money to the bank. Once the bank gets the money, the bank lender will notify the borrower of the amount that they got repaid by the SBA, and that part will be forgiven. It's interesting that there's a tax form 1099-C, which reports discharge of debt income if it was taxable. The IRS came out recently saying that there's no 1099-C reporting for that. Each bank is going to send letters or some kind of communication as to how much is being forgiven, some or all. Now, if the SBA decides to review the application and they need more time, then they can conduct their own review of it outside of the bank, and so forth. Now, the SBA may come up and give money to the bank, and the bank may give you a notification that you may be forgiven on some or all of it. The SBA with the Office for Inspector General can also review your application or borrower's application up to 6 years. There's appeal process in place. So the good thing to do is keep your records for a 6-year period, documenting all of the covered expenses as well as all the calculations in your application. So those are the important steps that you need to follow. And it's very important to follow them with precision. Otherwise, you risk the opportunity of losing some or all forgiveness. The next slide is, I think it's one of the most important slides for our listeners. These are the things that we identified, Joe and I and other people of our team, as to what planning ideas we should do to maximize our clients' loans forgiveness. The first bullet is choosing 8 weeks or 24 weeks in that period. And again, if you applied before June 5th, you have the choice of 8 or 24 weeks. If it's subsequent to June 5th, it's 24 weeks. And there's a lot of planning in it. Joe, what's some of the planning ideas that we've been talking about? And we're talking with our clients on whether to choose 8 or 24 weeks.
Well, one of the questions that comes up there, Barry, is why would anybody choose 8 weeks when you have 24 weeks to spend the money? That's clearly to be better. But as we were saying before, you got to be a little careful with that. Sometimes the 8-week period could be better. If you've spent the money during the 8 weeks in an eligible fashion, or even most of it, but you have not experienced an FTE reduction, you might be better off than the 24-week period where you had some FTE reduction. Maybe during the following 16 weeks, you had a loss of employees one way or another, and that could actually impact in a greater way than the actual spending less money. So that's a key point. This has to be looked at carefully for those people who qualify, or those that are prior to June 5th. Barry, I think also we need to make sure that we keep good records. I've always thought that was good accounting policy to begin with, but I think especially here in the PPP. Maybe can you just elaborate on some of the records that people should be keeping and why?
Yeah, Joe, thanks. What I was talking about just yesterday is, documentation includes your payroll records that you paid during the covered period as well as the base period. It also includes like any health insurance. And I would tend to keep copies of checks, copies of invoices, copies of 941s, your weekly or quarterly or whatever payroll records you have from whatever out third-party sources or your general ledgers. Keep copies of rents and lease agreements for the 6-year period. And also the other thing is how you calculated your FTEs. And if you used exceptions, the safe harbors, if you relied on any safe harbors, keep excellent records, because if you had a $200,000 loan and you got $200,000 forgiven, if the SBA comes in and later reviews it and they change it, you have to pay whatever they deny because you can't support. They're going to ask you for a check back, and this is money that you spent, and they're going to ask for a check back. So it's not a good situation. The other thing we're talking about is these payroll costs and maximizing the 60% bucket and prioritizing it. Joe, could you just go into why we think this is so important, and possibly even looking at it more?
Well, yes, as mentioned before, that you have to spend at least 60% of your eligible money in payroll costs in order to get forgiveness. Otherwise, you're going to suffer some of a reduction in forgiveness. That's clear. Because as you remember, that's one of the 3 calculations that make sure you spend 60%. We believe that it makes sense to spend even more than 60% if you can in payroll costs, maybe even 100%. And one of the reasons there is that it's the easiest to document. So when you're documenting utility costs and you're documenting your rent, and you have to start producing bills, invoices, and that stuff. With payroll costs, you just be able to give your payroll reports and your bank statements, and you're pretty much finished in terms of documenting your costs. I think it makes a lot of sense to try to maximize that 60% bucket. And we've also looked about monitoring those FTEs. That, as we've said before, has the biggest negative impact on loan forgiveness. We have methods in place. Barry, maybe elaborates some more on this. The FTEs, as we know, can really hurt people if you don't watch it carefully. So what should we be doing? How do we best monitor this?
So what we've been doing is we have these templates and monitoring on a weekly or monthly basis with our clients, their FTEs during the covered period. We looked at the base period, and if our clients are not meeting these FTE equivalents, or they're not getting to a full forgiveness, we're looking at these safe harbor rules to see if we can take advantage of them now. We're addressing them now on a contemporaneous basis, as opposed to after the covered period. So these are the strategies that we're using to get this loan forgiven, because that's going to help our clients the best. Joe, we're talking about retaining employees during the covered period. We're talking about this. I mean, recently, just on a call that we were on, some employers are talking about possibly letting go some of the employees. What are some of the pros and cons about retaining employees during the covered period?
Yeah, I've heard that too. Some people were considering doing this. Actually, we feel that this is key. I mean, this is the FTE. This is the biggest impact. If you don't retain the employees and you suffer an FTE reduction, you could be just giving away money. Some people, we've gone and we've quantified how much it saves to retain employees. I've had discussions with clients, each employee you retain saves $20,000, things like that, because we have calculations available. We have a spreadsheet that Chris has developed, and he'll probably talk a little bit more about that. That gives us terrific information to help us monitor this. But that's key to doing this, is retaining your employees, and even considering rehiring some people. You want to rehire employees, maybe because you're interested in getting those safe harbors. But of course, if you do that, they lose unemployment benefits. And we were talking before about maybe they'll be bringing back some unemployment benefits there too. And maybe you have to weigh one against the other. Barry, you've done a lot of analysis on this. Why don't you talk a little bit about what those issues are?
Look, I mean, some clients were doing very, very well before this pandemic hit. They had an assembled workforce that had a lot of value. They were contributing very positively to the business, making a lot of profitability of it. And this pandemic really hits hard to some of these industries, whether it be construction, retail, restaurant businesses, a lot of businesses, and their assembled workforce are in disarray. So if you had this PPP money and you can rehire your employees and meet some of these safe harbor, and you could pay people to do valued work to contribute to the profitability of your company, that's really enhancing your business and really keeping people employed, which is the purpose of this PPP money. And happy employees working as opposed to collecting unemployment. So that goes a long way. It's the non-tax side of it, but it's very important, and that's part of the business side. Joe, when we're talking about these things, I mean, literally, I'm getting 3 or 4 calls a day, literally, asking for help and asking for this. So could you just tell us some of the calls that you're fielding from some of your clients and some of our partners and staff regarding some of these calculations and so forth?
Yes, of course. Working with your advisor. Now, this bullet point obviously seems self-serving, and maybe it is to some degree, but most of the decisions we make are usually with people we trust. No man is an island, and obviously you need to speak to people who do this for a living. Make sure that you're getting the advice from people who are in the know. And we believe that with the proper guidance, you can get lots of information about this application process, finding ways to maximize your forgiveness. Clients call all the time to ask, what do I do here? Should I retain employees? We've gone through this already. Should I do something to maximize my forgiveness? Even here in this webinar, people are asking questions. We're seeing them come up. This is the kind of thing, none of us really knows all the answers, but with people who work with you closely and who know this stuff, you can get the maximum benefits out of this program. And that's really what we hope to do.
Mm-hmm.
One of the things that we've also talked about is whether or not people should be paying people bonuses or hazard pay. I don't have anybody with hazard pay, but Barry, I think you do. Maybe you should just tell everybody what this is about and why that would be something that you need to concern yourself with.
Yeah, because during that covered period, you get to spend during the 8-week period, which is pretty much over for most clients and taxpayers and borrowers, of $15,385. But if you're going the 24-week period, you have that $46,000 cap. You can consider paying some employees in the construction businesses, or some people in the scientific, in the medical, or even in the hospitals or nursing homes that are facing hazardous conditions. Companies are paying people hazard pay, or if you're not doing it, consider doing that, because if you have unspent PPP funds, these are ways to give employees money, hazard pay in this area, and then have it fully forgiven as opposed to repaying it. So these are some of the strategies and some of the industries that we're facing. And look, these calculations are by no means easy. They're complex. I actually consider them, or comparing them to doing a tax return, or similar to completing a tax return. And we have these models. And Chris, why don't you just talk about some of the things that Janover has done with some of these task force that you've helped us with and have been a major part of?
Sure. I'm going to try to be as brief as possible just in terms of time here. But as you mentioned, Barry, our PPP task force, we're doing all different levels of services for clients, whether that's just helping them get that initial PPP application in, to actually get the funds, whether they're just looking for us to review a forgiveness application. But most importantly, as you kind of mentioned, we developed a really detailed model to monitor and help calculate forgiveness on a real-time basis. So with that model, it allows us to run scenario analyses with our clients. Barry, you and I just yesterday had a call with the client. who is trying to figure out how certain changes in their business will affect their forgiveness, whether they hire a few people, whether they let a few people go, whether they reduce some hours for certain people. So that's all something we could help out with in terms of what our model does to do that. Finally, you know, we help monitor FTEs through that model, which in monitoring FTEs and spend, it helps, you know, a client determine if they should go with the 8 weeks or the 24 weeks. And finally, we help to, you know, analyze the safe harbor goals, kind of see what the safe harbor is that our client has to accomplish by a certain date in order to receive full forgiveness. So there's a whole slew of services we could do, which tie into that last slide in terms of the strategies to help maximize forgiveness. So I guess that's the end of our presentation today. On behalf of myself, Joe, Barry, and all of us here at Janover, we want to thank you for attending today's webinar. We really appreciate you taking the time. We really appreciate everyone kind of sticking around for this extra 15 minutes. A ton of really good questions came through during the webinar. We tried to answer most of them real time, but for any of those questions that we were not able to answer, or for any questions that you need further clarification on, feel free to reach out to any of the three of us. We'll be happy to answer any questions. Feel free to reach out to your professional who services your account at Janover. And I guess for everyone out there, have a great day. Thank you.
Thank you, everybody.
Thank you.